If you're someone who wants to leave your home country and not settle in one place, but instead travel, explore, and have multiple bases while maintaining a tax-friendly setup, this video is for you. Hi, my name is Yelena. I'm a strategy manager here at Nomad Capitalist, where we help people diversify their options and go where they're treated best. It is becoming increasingly difficult for people who want to lead a nomadic lifestyle to have a tax residency in a country that doesn't require physical presence, or at least not months of physical presence. What is obvious is that there's always a trade-off. Either you will spend 6 months or more in one place and become a tax resident that way, or you'll have to invest, donate some amount of money, or pay a flat tax, or a mix of these things. So it's always a trade-off between money and time. Now, there are not that many countries that have a tax residence scheme, so to say, that will give you the freedom of travel, but some that do have it and that we will touch upon here today are Antigua and Barbuda, Bahamas, Barbados, Anguilla, Cyprus, Malta, Gibraltar, Paraguay, Uruguay, and UAE. Now, starting the list off strong with a cult favorite is Antigua. So Antiguan tax residence can be a perfect option for people who want to split their year in different places. In order to qualify, you need to spend at least 30 days in Antigua, pay a flat tax of 20,000 US dollars, and rent or purchase an apartment for the entire year. An additional requirement there would be to show proof that you have at least 100,000 in yearly income, irregardless of the source. When you do qualify for this tax residence, you generally receive a certificate of residency and a TIN. So Antigua can also be a great option because you do not have to tie up capital in the country if you do not purchase real estate or make similar investments in the country. This way, when you're ready to establish yourself in one base, you do not have to go through the hassle of dealing with paperwork in order to detach yourself from Antigua. You can just not renew the tax residence after the year is up, and that's it. Thinking about taxes in Antigua, it generally is a tax haven. There are no capital gains or inheritance taxes. There's no wealth tax as well. However, gifts may be subject to transfer tax. So if you're looking at it from a tax perspective, it can be a perfect jurisdiction to grow your net worth and assets while spending only 30 days per year there, which in all honesty could be a perfect month of vacation in a beautiful island. Now, sticking in this area as well, in the Caribbean area, a good option could also be the Bahamas. Now, the Bahamas will grant tax residency certificate to people who have been granted permanent residency, typically under the investor program, which requires you to invest in real estate in the Bahamas, which can be quite expensive. Now, according to the government, if you obtain a permanent residence in the Bahamas, you will be eligible for tax residency if you spend at least 90 days in the island over a full year and no more than 183 days in any other country. If you do qualify for the tax residence, the government will issue a tax certificate which will carry a unique taxpayer identification number to show to your home country that the Bahamas is now your main tax residence. When talking about taxation, Bahamas is also a tax haven. It does not impose any income tax, inheritance tax, or wealth tax. There's also no corporate tax, withholding, payroll, or transfer tax levied on businesses in the Bahamas. However, businesses do require a license to operate, which is charged depending on the amount of revenue generated. In addition, there is property tax as well, which depends on the value of the property. So Bahamas can be a perfect option for some people if you don't mind spending 90 days in an island that can be perceived as quite costly. Nearby, you have Barbados. That can be a good option in the Caribbean as well, which will first require you to obtain a residence. On top of that, you can either spend more than 183 days in Barbados or have a house available to you at all times, either rented or owned. And you are required to send a notice to Barbados Revenue Authority that you plan on being a tax resident there. The property that you have, you cannot rent it out under any circumstances, so it must be available to you. When talking about taxation, there's no capital gains tax, wealth tax, or inheritance tax. And generally, Barbados does tax residents on the worldwide income, but they do offer a very advantageous non-domiciled tax regime. Under this regime, residents won't be taxed on worldwide income if that income is not remitted to Barbados. In order to apply for the non-dom benefits, you have to have a place of residence in Barbados, and you must declare that you plan to reside in Barbados for the next 2 years at least. The next option to consider in the Caribbean area is actually British Overseas Territory of Anguilla, which can also be a good option to consider. Here you can become a tax resident if you spend 45 days in Anguilla and pay $75,000 in flat tax to their Treasury Department. At the time of application, you must prove your readiness to make this annual payment of $75,000 for at least 5 consecutive years. You also have to own and maintain a property there, and that property has to cost at least $400,000, and you need to maintain it for as long as you wish to remain a tax resident there. Lastly, you will also need to provide a written declaration every year that you are spending less than 183 days in any other country. Now, this is a lesser known Caribbean option, which may not be an ideal solution for everyone, as it can be quite expensive and requirements are a bit steep. Now, looking a bit more south from the Caribbean area and Central America are 2 options in Latin America area that might be appealing to you, and those are Uruguay and Paraguay. For Paraguay, once you obtain your ID, you will have the option to obtain documents that can prove that you are a fiscal resident of Paraguay. Although you will need to spend at least 120 days there, which is not a bad deal. So, since Paraguay has a territorial tax system, all income sourced outside of Paraguay will not be taxed. Most people just register as tax residents once they get the residence permit. It is generally recommended for people who have a residence permit to file a no tax due return in Paraguay in order to ensure maximum benefits. On the other hand, Uruguay has a scheme where you can spend 60 days in Uruguay and qualify for tax residence, provided that you invest in real estate in Uruguay worth approximately $470,000 based on the current exchange rate. Someone who recently acquired Uruguayan tax residence has the option between being taxed under non-resident income tax rules or natural person income tax rules. Choosing to apply for the former effectively results in a tax holiday. If you apply for this program, all the income which is abroad will not be taxed, although the income obtained from Uruguay will be taxed at regular tax rates. In practice, the tax holiday can last for 11 years and can be a very beneficial tax residence if you're willing to invest in Uruguay, approximately, as I mentioned, $500,000, which can be seen as quite a lot. Now, if you're somebody who would rather be closer to Europe or be a tax resident of a European Union country, you should be aware that generally speaking, in Europe, you have limited options when it comes to tax residencies that are suitable for nomadic people, as most countries will require you to live there full-time in order to qualify. However, there are a couple that might be interesting. Starting with Cyprus, the main aim of introducing a special tax regime or non-domicile concept in Cyprus was to constitute Cyprus as a prime choice of destination for people wishing to move their personal tax residency elsewhere. The non-domicile tax status in Cyprus will allow you to be exempt from being taxed on your income on dividends, interest, and rental income. Specifically, you will be exempt from the special defense contribution on these types of income. The process of becoming a tax resident is the same for EU and non-EU citizens, but it is different when it comes to obtaining residency and work permits. In this case, EU citizens don't need special permits. They can go and live in Cyprus as an EU citizen. However, non-EU citizens must obtain the relevant visa and permits. Now, there are 2 ways that you can become a tax resident in Cyprus. First is you spend 183 days or more there, and the other one is spending 60 days there. Under the 60-day rule, you can be considered as a tax resident of Cyprus if you indeed do spend 60 days there in a year, if you have a permanent home in Cyprus, either owned or rented, if you do not remain in any other country for more than 183 days, and you are not deemed a tax resident of any other country, and lastly, if you carry out a business in Cyprus. With satisfying these requirements, you can obtain a tax certificate to show to other countries. This is generally obtainable from the Cyprus tax office following the relevant application. Now, sticking with Europe, Malta has a program which is called Global Residence Program, or GRP, which includes a remittance-based taxation if you qualify. Under the remittance basis of taxation, all income arising in Malta is subject to tax, regardless of where it's received. However, income coming from outside of Malta is subject to Maltese tax only if and to the extent that it is received in Malta. In this case, where the income is remitted to Malta, it will be taxed at 15% flat tax. And when it comes to capital gains arising outside of Malta, they are not subject to tax even if they're received in Malta. So that is one exception there. Under this program, you do not have to spend any time in Malta to maintain the tax residence. However, you do have to pay a flat tax of 15,000 euros each year and either purchase or rent a property in Malta. In addition, there are certain thresholds that need to be met when buying or renting a property in order to qualify for this program. So if you're not opposed to the flat tax on a yearly basis and investing in Malta, this may even be a better option than Cyprus, as both are bureaucratic, but in our experience, Cyprus more so than Malta. On the other side, in Europe, there's also Gibraltar, which has a flat tax that needs to be paid on a yearly basis, a requirement to purchase or rent a property there, and the requirement of minimum net worth of 2 million British pounds. If you satisfy these requirements, you would not have to spend any time in Gibraltar and you would be deemed a tax resident. Now, going a bit east in Eastern Europe, Georgia is by far the best option. There is a high net worth individual tax scheme through which you need to only spend 1 day per year in Georgia to maintain the tax residence. However, in order to qualify for this option, you should prove that you either have a total assets and net worth of at least 3 million Georgian laris, which is around 1.1 million US dollars, or you must prove that you received annual revenue above 200,000 Georgian laris, which is approximately 78,000 US dollars, in each of the previous 3 years. In addition to being a high net worth individual, you must either hold a Georgian residence permit, which you can obtain easily by buying real estate in Georgia that is worth at least 100,000 US dollars, or you have to prove that you receive at least 25,000 Georgian laris in Georgian sourced income in 1 calendar year. Although, starting from April 15th in 2023, the Revenue Service will require that you show proof that you have at least 3 million Georgian laris worth of assets, out of which 500,000 US dollars need to be in Georgia. On the other side, Georgia has a territorial tax system, which means that you are only taxed on income that is sourced in Georgia. So income received by a tax resident, which is not considered Georgian sourced income, will be exempt from personal income taxes. Now, these will be some of the best options when looking into the European area. However, if you prefer the Middle East, then UAE might be for you. Recently, they enacted a new rule where you can be a tax resident with just spending 90 days per year there, which can be ideal since it's considered a tax haven. So if you want to find out more about it, you can check out one of our other videos where we go into detail explaining how this process looks like. Now, if you're still confused about which route to take or which one would be the best for you, taking into consideration your assets and income, you can apply to work with us, and our dedicated network of professionals can help you find the right fit for you and help you go where you're treated best.